Good morning, everyone. Today we're going to focus on a webinar on share-based payments from both an accounting, corporate advisory and also a tax perspective. So my name's Alan Finnis and I'm a Director in Assurance and Financial Reporting, Accounting and Advisory Services. And today I'm also joined by a couple of my fellow directors at William Buck, Liz Smith, a Director in Corporate Advisory. Liz, would you like to just say a couple of words?
Yes, good morning, everyone. As Alan mentioned, I'm a Director in Corporate Advisory at William Buck. We do a lot of valuations for a lot of purposes of businesses, shares, intangible assets, options, assist in this buying and selling of businesses, do due diligence, also do valuations for litigation support purposes, and assist in doing investigating accountant reports for IPOs. Thanks very much for joining us this morning.
Thanks, Liz. I'm also joined by Jonathan LaRosa, a Director in our Tax Division.
Thanks, Al. Good morning, everyone. For those who don't know me, I'm a director or one of our directors in tax at William Buck in Melbourne, and I advise clients regularly on share schemes, share plans and things like that. And I'll have the pleasure of taking you through the wonderful simplicity of tax today. Thanks, Al.
Excellent. All right, thanks, guys. So just to give you a bit of an introduction on today's session. So obviously the AGMC season has just about concluded for most people. I know there are a few people running their meetings in December this year just because of the leniency due to the COVID situation. But I think the majority of AGM notices have gone out now, and you will see a lot of those have actually issued share-based payments. So today is just, I thought it was quite a timely session to really put something out and discuss share-based payments from an accounting, valuation and tax perspective. So the session today is designed to run for about 45 minutes to an hour with an opportunity to ask questions both at the end and throughout. If you have any questions, please add it in the Q&A function in the Zoom software. Alternatively, you can email either myself, Liz, or John after the presentation, and a copy of the slides will also be distributed. So let's get started. So accounting for share-based payments. So AASB 2 is the main standard that we tend to look to when we talk about share-based payments. There's two main types of share-based payments, which are cash settled and equity settled, and the definitions are kind of there on the screen for you. I think the majority of in situations that we see are equity settled, predominantly in kind of the startup tech space, and also I've already got a question. That's excellent. I'll come back to that shortly. In terms of share-based payments, the equity settled ones tend to be more common. This is predominantly driven by the space that most of the people on the call today will be operating in startup tech or startup industry, mining exploration, etc., where it's almost an alternative to settling obligations in cash. So in terms of that's really what we're going to be focused on today. So there's three main types of share-based payments. So first off, we have performance rights or shares. So majority of the time people are issuing performance rights. So performance rights is essentially a right to receive shares on completion of specific performance targets, performance conditions. So either market conditions, non-market conditions or service conditions. So we'll get into that a little bit more as we go on. A share option is essentially an option to buy an instrument, an equity instrument at a fixed determined price at a permitted time in the future, and we'll also get into understanding those. And then what's becoming more and more common over the past couple of years in particular is these employee share loans. So these are effectively limited recourse loans that are given out by a company for the purchase of shares. Often they're also linked to specific performance conditions, and we'll talk about the accounting for them shortly, because there is a common misconception there that should be treated as a loan on the balance sheet as opposed to a share-based payment. So we'll get into that as we go through. So what I want to really talk about now is a high level, the accounting treatment on initial recognition of the share option. So the share-based payments should be expensed unless they meet the criteria to be capitalised under another accounting standard. So this is predominantly AASB 116 or AASB 6. So for those that are not familiar with the numbers, so AASB 116 is the property, plant and equipment standard, and AASB 6 is a mining exploration and tenement standard. So effectively, if we're looking at AASB 116 and we have an asset that we're bringing into service, as you may be aware, under AASB 116, you're allowed to basically capitalise costs into the asset which were directly attributable to bringing that asset into service. This could be kind of labour and installation costs in particular. Say, for example, rather than someone may install a machine for you, and rather than paying them cash, we decide to pay them shares. The cost of that share-based payment can then be capitalised into the value of that asset. Likewise, if in the mining space, if somebody's doing some drilling for you or some exploration activities and you pay them in shares, you can capitalise that as part of the arrangement. The expense may be recognised in full at grant date, or it may be expensed over the vesting period, depending on the terms of the instrument. The total, and we'll get into that as we go through the presentation. The total value of any share-based payments issued may be adjusted due to various circumstances, such as somebody leaving the organisation. So this is something that we'll kind of come into in more detail going forward as we expand the discussion today. And also, in terms of modification of share-based payments, there's also a number of significant rules there which can trip you up. So I really want to discuss that with you today as well. And then, as I mentioned, the employee loans are also important to consider. So grant date. So why is grant date so familiar fundamental to share-based payments? So when we talk about grant date, this is a date that we value the options. And AASB defines the grant date as when another party agrees to enter a share-based payment arrangement, which brings the counterparties an understanding of the terms and conditions of the arrangements. One of the key things to note here is a lot of these share-based payment arrangements need an approval, an AGM, and that's what I just spoke about at the start of the presentation. So when we are at our AGM and we get our approval, that's effectively our grant date, and we should start expensing our share-based payments from that date. Alternatively, if there's no requirement for the share-based payments to be approved at the AGM, maybe it's for a non-direct, an employee share scheme where the participants aren't directors of the organisation, they don't need the specific approval. It'll be the date that the two parties agree and sign off on the kind of contractual arrangement. So grant date is fundamental because it determines when we start recognising an expense for these instruments. So performance conditions. So when we talk about valuation of share-based payments, and Liz will talk about this in more detail, but we have three main conditions that we look at when we determine when we value our options. So we have market-based performance conditions, non-market-based performance conditions, and service period conditions. So what are those? So an example of market-based performance conditions are a share price achievement, so a VWAP, volume weighted average share price greater than 25 cents in 20 business days, for example. So there'll be a specific share price target that we'd have to adhere to meet this market-based performance condition, which would basically allow us to issue the performance rights or performance shares to our participants. A market capitalization goal, something that's based on a share price, something it tends to be obviously a market-based performance condition. So there's those two examples there are really kind of the key ones when we talk about a market-based performance condition. And these are accounted for at grant date of the share-based payment arrangement, and they aren't adjusted subsequent to the grant date. So once we've kind of issued our share-based payment, we perform a valuation on that, and then at grant date we lock in what our value of those options is, and then we don't go back and modify that. And if we do, there are specific criteria that you need to follow, which I'll explain shortly. The non-market conditions, so these are kind of a little bit more kind of performance conditions in terms of how management can really drive the business. So earnings per share, revenue, an achievement of a feasibility study for an exploration area, for example, or achievement of clinical trial results. If you're a life science organization, these kind of criteria tend to be the ones that when we issue shares to our CFO and CEO, these are the ones that we tend to look to, just because it drives their performance. Sometimes with the share price and such like, sometimes it's not always kind of, the market doesn't always value the efforts that have been put into by the employees. So I guess if you were looking to motivate someone, a non-market-based performance condition is something that they can more actively control, and you could potentially get a better outcome there for your staff. So accounted for grant date again. The difference here is with a non-market-based performance conditions, you allow to apply a percentage judgment component to the fair value of the assessment. So say, for example, you've got the exploration area of interest. Effectively, you could say, okay, if I'm going to drill, I'm going to achieve a mining license by X date. You basically put a percentage weighting and say, I've got a 50% chance of this actually happening, and you then apportion 50% of that expense to the share-based payment. This is, with the percentage judgment, you're allowed to adjust this at each reporting period. So that's important to kind of actively monitor that at each reporting date. And I'll show you how that comes through in the disclosures to the financial report shortly. Service conditions. So some of the share-based payments that you might see out there stipulate a service condition. And when we talk about service conditions, we talk about length of service of a particular employee. So you may be given a portion of performance rights, and it may be stipulated of you don't get these rights until you've been with the company for a period of 3 years. So with these service conditions, we actually value the share-based payment on grant date, and then we will expense that over the life of the service condition. So say, for example, we have $300,000 share-based payment expense with a 3-year performance condition. You'd effectively expense $100,000 in each year, and that's how you would roll. One of the things that you're allowed to also do with the service conditions, similar to the non-market conditions, is that you're allowed to kind of adjust at each reporting period for things that would happen. Say, for example, you have a group of share employees that you've offered these share-based payments to. Say there's 100 employees. At the end of the first year, well, there's still 2 years left. 25 of those employees have moved on to another organisation, no longer with you. So you could effectively reverse their vesting charge back through the P&L as a credit. And that's something that you can monitor at each reporting period, just to make sure that the expense is fair and reasonable. Impact of a good leaver. Sometimes we do have good leavers, and I just wanted to make note of that. It's usually someone more senior in the organisation. So there may be, for whatever reason, an agreement that somebody may be leaving an organisation, and they do have a lot of performance rights on foot. It may be that they are entitled to get those rights despite leaving, in which case you'd effectively accelerate their personal expense for the full amount of the rights on their leaving date. So that's just something to bear in mind, and it does happen from time to time. Okay. One of the other things I just wanted to talk about when we talk about the accounting for share-based payments is quite often companies put out announcements where they'll do a rights issue or capital raising, and for every share that you subscribe to, you get a free option. Because these arrangements are effectively already kind of a share-based payment transaction in issuing the share, the value of the option is priced into the purchase of the share. So there's no additional expense for these options. So whilst you have these options and you'd be obliged to issue shares on those, there's no share-based payment expense from an accounting perspective that you'd have to record in your books. So say, for example, you raised, in this example, a company proposed to raise $2 million through the issue of 40 million shares. Effectively, in your disclosures, you'd have 40 million options as well, but the options wouldn't have any value, whereas in your equity note, your 40 million shares would have the value of the 2 million, obviously less any cost of capital raising that you may have incurred. Modifications to share-based payments. So there's a couple of things here to watch out for, especially if you're kind of in that pre-IPO space and you're thinking about doing these share-based payments transactions. I'd sincerely recommend to you that, when you do set these arrangements, you've spoken to the lawyers and maybe even the ASX about pre-approval, etc., to make sure that, once you've issued them, there's not going to be any hurdles that you're going to have to jump through further down the road, which means you'd have to make changes to what you are doing. this really has implications for, whereas if we issue share-based payments and then we choose to cancel them, we effectively have to accelerate any remaining vesting, and we can't reverse that expense once we say it's been cancelled. This is a very fundamental part of AASB 2, and it's very strict in this manner. In addition, if we do a modification and the value of the share-based payment actually increases, we're required obviously to take the additional expense. However, on the other hand, if the value decreases, then we don't change the original calculation. So that obviously has big implications. Especially if you're in a pre-IPO space, you may issue a lot of share-based payments to various parties as part of the process. If you have a discussion with the ASX, and then they're not so happy with what you've put out, you've then got this issue that you've got to then go back and cancel them, and then you've got to reissue them. And it can, I know it's obviously just it's a paper entry from an accounting perspective, and it's an add back from tax, but from kind of a perception side, it's not a great look. So, and obviously it will obviously hurt the underlying profitability. So it's just a couple of real important points to focus on there before you kind of enter into these arrangements. Just on the employee loan plans, these are becoming increasingly popular. Effectively, these are options in disguise. The reason for this is the loan gives you the right to buy an option, but if the option is out of the money, the participant is not going to repay the loan, so the arrangement is just going to collapse. So effectively, when you bring these on book, you effectively do a share-based payment valuation, and then if the loans are paid back, your journal entry is going to be debit, cash, credit, equity, and then you will move the amount component out of the reserve into share capital for the share-based payment expense. So no loans are held by the participant on the company statement of financial position, and that's just important to note. Finally, for me, I just wanted to do a little bit on disclosure, but I might just have a look at this question first. So it's interesting how companies treat exercise of previously issued options. Okay, so Pash, I think I may have covered this already during the course of the presentation, but we value our options at grant, performance rights at grant date. So once we've got our valuation completed at grant date, we don't subsequently go back and revalue them. The only changes that will be in terms of the probability situation, which is what I discussed previously, and whether or not there's any changes to the likelihood of certain things happening or people leaving the organisation. I hope that answers the question. Just in terms of disclosure, I've got a couple. When we do have share-based payments, it does have a fundamental impact on the financial report, impacts the remuneration report, the key management personnel disclosure, the director's report, and also the notes to the financials. So I've got a quick example that I just want to run through for a couple of minutes, and then I will pass over to Liz. So I'm just going to exit out of this. And I'm just going to go into this one. So just to kind of give you a run through of how this kind of impacts your financial report. So this is your director's report here. And then we've basically listed our shareholdings for each director here. And if I move forward down to the remuneration report, we can see that we've got our share-based payments, the expenses here for each director and participant in either performance rights or options or equity settled share-based payments. We've also then, if we go down further, we have our options that we've issued. And then in terms of our performance rights, this is what I was kind of talking about market conditions, non-market conditions, probability of the conditions occurring, and then the fair value for each of the performance rights. So this is kind of the summary disclosure that the accounting standards requires that you do to be in compliance with IFRS, and this is obviously for the Corps Act as well, being in the remuneration report, but you will see this table in the back. One of the annoying things about the disclosures is the remuneration report and director's report is obviously focused on the Corps Act. Your financial statements are required to comply with accounting standards, so there is a bit of duplication between the two sections. So I will just quickly go down and show you the notes to the financials, and then we'll move on. So as I was discussing here as well, as we, some of the performance rights issued were in relation to specific performance targets on the mining and exploration. So this has obviously been capitalised here in the E&E costs, which is in line with AASB 6. And then just finally, this is obviously our reconciliation and movement tables. And we get into our share-based payments notes where we talk about the different types of instruments that are issued. We have all our valuation parameters here, which Liz will run through you shortly. And we talk about our valuation methodology. And again, this is the same table that was in the remuneration report. So these are kind of the key disclosures that need to be included. If you need assistance, we're more than happy to advise either obviously our audit clients and any non-audit clients that may need some assistance are happy to help. Okay, so I'm going to hand over now to Liz. I'm just going to bring the slides back. And yeah, over to you, Liz.
Thanks, Alan. And would you mind actually, Alan, next slide, if that's okay? Great, thank you. So I thought it would be helpful to start by explaining some different types of options that do exist and what the terms are, so that when you see them, you know what they're referring to. So the first one is in relation to a call option, which is the one that we're spending most of the time on today, because if someone normally has an option to purchase shares in a company, it is a call option to the person that holds those shares. The second one is in relation to a put option. See these less frequently. The last time I saw an example of this, because this is where the holder is given the right but not the obligation to sell. So in a vendor was selling his business, he decided to sell 80%, retain 20%, but as part of the terms of the agreement, he had a right to be able to sell at some point in the future, remaining 20% for the same price. So that was what we would call a put option. Then there is things like, in terms of the types of options, there's American options, which is basically where the holder can exercise at any time over the life of the option. So if the option has a 5-year life, you can exercise any time that maybe the share comes into the money over that 5 years, as opposed to a European option where you can only exercise it at the very end. So you have to very much wait. So if the share price goes up and down during the life of the option, you can't exercise when it's in the money at that point. You have to wait to the end of the option period. And then there's Bermudan options, which basically have a number of fixed dates at which you can exercise or not. So they're pretty rare. So in terms of the value of the option, what makes up the value of the option, there's two real parts to that. The first one being the intrinsic value, and this is what people will refer to as being in the money value. So I'll give the example of Woolworths. Woolworths, when I last looked at it, was trading at $37.50. So if you had an option to buy Woolworths shares for $30, then your option would be in the money by $7.50. So the intrinsic value of that option would be $7.50. Most of the value when we're doing options, because when they're exercised, typically they're exercised at a price that is more than their current trading price, but the option still has value, and the value is in the time value. So if we take the example of the Woolworths shares before, and let's say you're issued options with an exercise price of $40. So basically at the moment it's out of the money, but at some time in the future, it's likely that Woolworths shares will exceed $40. And at the time that they exceed it, then you potentially have an opportunity to buy and get some value out of the option that's been provided to you. So one of the things that we'll talk about is, so the likelihood, the longer the time period of the option, then generally the more chance that the option is going to have a higher valuation. So some of the other things in relation to what we normally consider as inputs to valuations, and you'll note that most of what I'm talking about at the moment, I'm just talking about option valuations, and I know that Alan has spent some time talking about employee share schemes and employee loans and performance rights, etc. But fundamentally, with all those instruments, what we're trying to do is value the option component in it. So the inputs are largely the same, no matter what the actual instrument is in the way we go about assessing value. So these inputs are typically the underlying asset price, which I'll talk about a little bit more, but it's usually the share price of the company at the date of grant date, so the date we're valuing the option. Then there's the exercise price, which will usually be set in the terms of the agreement. So as we gave with that Woolworths example, the higher the exercise price, then the lower the option value, because basically, whether it's in the money or not in the money, the way that impacts that. The time to expiration. So as I gave with the Woolworths example, if you've got a 3-month option versus a 5-year option, more chance that the share price will go up. So the more likelihood you get value out of it. Volatility. So the volatility is a reflection of the likelihood of the share price going up or down. So with options, because as an option holder, you're not exposed to any downside risk associated with shares going down in value. So you only really get the benefit, but you do get the benefit from when the shares go up. So this is the reason why that the higher the volatility in the shares, then the higher the option value is likely to be. Another input is basically the risk-free rate, which needs to be the risk-free rate over the expected term of the option. So if it's a 5-year term, or the option is going to have a 5-year likely life, then the risk-free rate would be the risk-free rate for that 5-year period. The reason that we use risk-free rates as opposed to other types of, discount rates is that the risk associated with movements in prices, etc., is taken into account in the probability factors in the valuation models that we use. So we're really just purely trying to take into account here the movement in basically the time value of money. And then cash dividends. So with a share like Woolworths, clearly for the period that you have the option but not exercising it, and Woolworths is paying dividends, then you will be missing out on those dividends. So those sorts of things need to be factored into the way we value the option as well. So there's 3 main methodologies that we can use to value options. These are basically, the first one probably everyone's familiar with is a Black-Scholes. So this is for very simple options. So the example of the Woolworths one I gave before, where it's literally, a set exercise price, the market price, and so you can pretty much easily work out the option using that methodology. Then the binomial model is, and I'll run through an example so you can see what the binomial model looks like and how it works. And so this is a model we normally go to when we have market-based conditions like Alan was referring to before, in terms of where the share price has to hit a certain level. So that will be the most typical model we will use when there is market-based conditions. Another one that we use from time to time is also the Monte Carlo methodology. And this is for where it's quite complex to work out. For example, there was one a situation where a private equity company had basically provided options to the management team, and they said, right, in the event that I think the company is currently worth about, say, 25 million, and they said, right, in the event that the company sells for 50 million, then you'll get 5% of any amount above 50 million, between 50 million and 75 million, and you'll get 10% of anything between 75 million and 100 million. So you can imagine from this that there's a whole range of variabilities that could happen in relation to the timing of exit event, what the likely forecasts and multiples are going to be for under different scenarios. So that's can create and so we mathematically work that out with a complex model, which is using a Monte Carlo methodology. So most of the inputs in terms of doing most valuations are fairly standard in terms of, so the two in terms of the risk-free rate and whether it's paying dividends, that will be the historical dividend yield. So the two things that typically generate sort of judgment potentially, firstly might be the share price, and secondly might be the volatility. So with a share price, if you've got a company like Woolworths, well, clearly it's highly liquid and traded on the stock market. So you determine the grant date, it's very easy to reference what the value of those shares are at that point in time. But for a private company, it could be, much harder to work out and may require some sort of valuation, or when was the last capital raising, and if the capital raising wasn't recent, how was that capital raising priced, and if you were to do a capital raising today, what would the likely movements be? Similarly, if you got a valuation back at a point in time, is that valuation still reliable, or if things move too much to indicate that that valuation wouldn't be reliable anymore? So that is something that we'd need to look into, and requires a bit of judgment for valuation of a private company. With listed companies, even some listed companies, whilst their shares might be listed, their shares might be illiquid. So the actual, current share price may not be an accurate reflection of the value of the underlying share. So that's something that we need to consider as well. One thing that John wanted me to mention was in relation to, so this is for tax purposes, for companies that meet certain criteria, being that and its employee share scheme. So, and they're a small business, they haven't, under the Tax Act, they have been incorporated for less than 7 years, they're preparing accounts in accordance with accounting standards, they've not raised capital of more than 10 million during the last 12 months, and they reasonably expect that there will not be a change in control of the company within the next 6 months. In those situations, the tax office may allow the company to basically just use the net tangible assets, excluding the value of any preference shares. So that is obviously, in a lot of situations, likely to provide a fairly low valuation of the company, because with a lot of startups, a lot of the value is going to be, or most companies, a lot of the value is in the intangible assets. And so that value is getting excluded if this methodology is allowed to be used. So I mentioned one of the common subjective factors being share price. The other subjective factor that we need to consider is the volatility of the shares. And as I indicated before, the volatility is a reference to the likelihood of the share, of the option, or the share and the option going up in value over a period of time. So I've just pulled some examples just to give you an indication of, the Commonwealth Bank being the first one, and you can see whilst it's had some volatility over the last 3 years, on average, in the median volatility is relatively low at 13 to 17%, as is Woolworths. The next one listed there is Afterpay, and you'll see, so that's obviously got higher volatility because it's a higher risk stock than, and would expect more share price movement than we would say in the Commonwealth Bank. Interestingly, when I saw those numbers for Afterpay, I thought, well, actually that looks quite low. I would normally expect something like Afterpay to have a much higher volatility than that. And when in fact you do go back and look at it, you'll see that the 3-year volatility in the first couple of years, it didn't get much market, wasn't really noticed much by the market. So its actual share price was relatively stable for the first 2 years. But in the last 6-12 months, it's really, had an enormous amount of volatility. So again, we need to not just think about what has it actually been, because this is meant to be a reflection of what the forecast volatility is likely to be going forward. So in a situation like that, in fact, all situations when we're doing valuations, we will normally try and get comparable company volatilities to not just see what the company's done, but what other companies in that sector might be doing as well, to get a feel for what the likely volatility is. So just go back a second, Alan, just in terms of the other last one then is a mineral explorer, and you'll see, as I would expect, that has quite high volatility between 90 and 100% on average. And again, quite wild ranges between its volatility at 36% and 300%. So I thought might be helpful just to run through a very basic example using a binomial model, so you can see how it works and how the binomial model works in practice. So here we have basically a strike price or an exercise price in this particular example of 25 cents, with the underlying asset at the date of grant date having been worth 20 cents. We'll say it's a 1-year option life, volatility at 50%. The interest rate, risk-free rate is 1.5, and we're saying this particular asset or entity is not going to issue dividends over that period. So this is an example of what the binomial model does and looks like. So you'll see at the very end is basically the current share price, and the one that's circled is basically the option value. And so anything in grey there is basically a calculation and the way the binomial model is working and calculating value. The items in the white are basically based on the volatility that's been assessed for that particular share, but what the share price is expected to do. So you'll see, it starts at 20, and then based on the certain volatility formula, after 1 month, it might go up to 23 cents or down to 17, all the way up over the 12-month period of the option. So it's showing the likely probable share prices range given the volatility and the starting share price. And you'll see right at the very end there that basically there's no value in the option at certain prices. So all that area that's grey is basically reflecting that fact that at those sort of values, there's going to be no value in the option because the share price is likely to be lower than the exercise price. Next one. So this is showing exactly the same calculation, but with a higher volatility. So you'll see here that because it's got a higher volatility, we go from, rather than an option value of 2 cents to an option value of nearly 5 cents. So that's sort of the impact that volatility can have on shares. And similarly, with this same model run with a lower volatility, and again, it takes the value downwards because of lower volatility from 2 cents to 0.003. I thought here I would show you an example of the binomial model using a share price hurdle. And so whilst it still has an exercise price of 25 cents, you actually those options don't vest unless the share price hits 30 cents at some particular time. And so normally, whilst the reason I've circled the 26 cents there is normally at that point you would have some form of option value at 26 cents because the option would become in the money because you'd have a value of 26 cents versus the exercise price at 25 cents. But what we have to do is override that formula in the option binomial model to say, well, at 26 cents because of this hurdle, there's actually would be no value in that option. So that's really playing with the formulas in the model to take into account the impact of any hurdles that exist in the terms of the option. So you'll see there that the share, without that hurdle in it, the option value was 0.0248, but once we put that hurdle in, it reduces the option value to 0.02. So sometimes the hurdles, depending on the nature of them, have a really material impact on the value of the option. And the other thing which Alan talked about before is just the so all I've spoken to about then is how we deal with market-based hurdles. If it's a non-market-based hurdle, we basically, do the valuation, assuming no hurdles, and then the hurdles are basically applied to the probability of the number of instruments being issued, as Alan referred to before. So not a valuation consideration, it's more of a management probability assessment. Thank you. So I'll hand over to John now.
Great. Thanks, Liz. Thanks, Alan, for all that great information. I was actually just thinking, Liz, when you were going through the Monte Carlo valuation method, I had this picture in my mind for a moment of a valuation being spat out from a roulette table or something. But I'm sure it's not as simple as that. And I'm sure I've totally missed the point. But anyway, thanks everyone for joining us this morning. Once you've gone through your legal and accounting and valuation issues and you think you've got them all lined up, tax just loves to come in at the end and try to overcomplicate everything. And I guess one of the key points that I'd like to get across today is that when you're considering equity arrangements, particularly employee equity arrangements, getting good tax advice at the beginning is absolutely critical so that everyone has visibility over the tax outcomes throughout the entire arrangement. And you minimise the chance of any tax surprises, particularly down the track, which can tend to derail things if they're unexpected and actually cause incentive plans to become a disincentive. And I've seen that happen a number of times. So that's my plug for today. The structure of my part of the presentation is first I'll talk you through the tax treatment of share-based payments from the perspective of the share issuer. We'll just quickly talk about income tax and GST issues there. And then we'll talk through, just at a very high level, income tax and employee equity planning. I could spend an hour just going through the detail of tax and employee equity planning, but we'll just go through the key top line issues today. Okay, so tax treatment of share-based payments for an issuing company. Really, the tax treatment revolves around the particular service or asset that you're acquiring in exchange for you issuing shares. So 3 categories of things that you might be acquiring that we can consider today. So the first one is issuing shares for goods or services. And then we'll talk about issuing shares in order to acquire an asset. And then last, we'll talk about issuing shares under an employee equity plan. So if you're issuing shares for goods or services, luckily we have an income tax ruling which goes through, it's only a 30-page ruling, so one of the shorter ones. An income tax ruling which sets out fairly clearly what the income tax implications are. So I guess as an example, if Alan was going to provide you with an auditing service and you were going to pay Alan by issuing shares in your company, and I know that's breaking any number of independence issues there. I know Jeffrey's jumping up and down. So you wouldn't actually do it, but just as a hypothetical example. So Alan issues you an invoice, you pay him in shares. The question is your auditing fee tax deductible? And the commissioner says, no, it's not, because if you just issue shares to pay for that service, you haven't had a loss or outgoing, which is a critical element of claiming a tax deduction under Section 8-1. But then the ATO does go on and say, well, if you structure it differently, the arrangement, then you can get a tax deduction. And so the change to the structure is what we call an offset transaction. And under that type of arrangement, you'd actually have 2 transactions set up. So the first transaction would be Alan would provide you with the auditing service, and the arrangement would just be a normal one where you'd agree to pay him in cash. But then let's say Alan was just interested in acquiring shares in your business separately. And it just so happened that the number of shares that he wanted to acquire equated to the value of the shares, equated to the value of the audit service. So if you set up a second transaction where Alan wants to acquire shares and he owes you money to pay for those shares, but then you agree to offset the amount Alan owes you in exchange for the amount that you owe Alan, then you can potentially get a tax deduction in that scenario. So just something to be aware of there. From a GST perspective, GST isn't complicated by issuing shares in exchange as payment. You just look at your ordinary GST rules around whether or not you can claim an input tax credit for the service or goods that you've received. There is one small complication in that GST treats the issue of the shares itself as an input tax supply made by the share issuing company. And when you're making input tax supplies, then you just need to think about, well, can I claim all of my input tax credits on any related expenses? Do I have to analyse the financial acquisitions threshold, for example, and am I denied input tax credits? So just something to be aware of. Okay, on the next slide, what happens if you issue shares to acquire assets? So again, tax ruling 2008-5 gives us the answer here. And the Commissioner says if you're buying trading stock, then that you generally can't claim a deduction for the value of the trading stock. Again, similar to you haven't had a loss or outgoing to acquire that trading stock under those rules. That is unless you enter into an offset arrangement, as we spoke about, or if you're actually buying trading stock as part of an entire business acquisition, and then you can get market value on the trading stock there as your tax value. If you're acquiring PP&E or depreciating assets, then we're dealing with different tax rules. We're not dealing with Section 8-1. So tax law will allow you to have a tax depreciable value for those PP&E assets set at the market value of the shares that you issue in exchange for acquiring the asset. And a similar outcome arises if you acquire capital gains tax assets. So for example, land, or you acquire shares in another company, your CGT cost base will be set at the market value of the shares that you issue to acquire that other asset. And that is unless you use a CGT rollover or something that can impact on that. Again, GST isn't complicated in these scenarios, and you just look at your usual rules around can you claim an input tax credit for the cost of the asset that you're acquiring. And then finally, on the next slide, what happens when you issue shares to employees? Generally, the share issuing company or the employer can't claim a tax deduction for the value of the equity issued. Again, there's no loss or outgoing for Section 8-1 purposes. But there are some provisions where you can claim a deduction. So if you set up an employee share trust, there is an avenue there to claim deduction, but setting up employee share trusts is pretty complicated, and wouldn't recommend it unless you're a large employer. I have thought about, could you claim a deduction if you issue shares to employees and do the offset arrangement? And you could, but what will happen is that that arrangement will actually just turn into like a bonus arrangement for the employee. So even though you can claim a tax deduction for the bonus, the employee will be taxed on the full value. You'll have to withhold PAYG, and you might disincentivize everyone and derail an employee share plan. So just to be aware of that. Next slide. So this slide is really just identifying that for tax purposes, identifying the value of equity being issued is a fundamental part of understanding the tax outcome. So the value drives the tax result. And so there are any number of incentives there to try to decrease value at particular times to decrease tax, or to, I guess, create less value by having people pay you for things. So there's less of a gap between the value of the equity you're issuing versus what you're actually being paid in exchange for that value of equity. The time of valuation is also critical, and so we're not just dealing with grant date, unfortunately, for tax. Some key valuation points here could be grant date, could be the vesting date of shares, it could be upon the satisfaction of performance conditions, could be when some share sale restrictions end, or it could be at the time of a trade sale or an IPO. So there are any number of different valuation points. And as Liz mentioned, for private companies, that's going to throw a bit of a spanner in the works sometimes. So as part of any equity planning arrangement, it's also really good to know when a valuation of your shares is required so that we can plan for that as well. As opposed to coming down the track and an employee asking you for a share value and everyone's scrambling around trying to figure out how to do that. Okay, so I'll move on to employee equity plans. So we've spoken about why you'd enter into an employee equity plan. That's fairly clear. On the next slide, the different types of plans we see, again, just to mirror Alan's comments, we see share plans, option plans, performance rights plans. I guess one of the fundamental things is in the planning of an employee equity plan is just understanding the key objectives. And so some of the key objectives that we need to flesh out first are you putting this plan in place to raise cash, or is it supposed to be a cashless type of plan? So, a non-cash remuneration strategy, or are you actually trying to raise cash for the business? And if you're raising cash, then that requires funding arrangements from the share acquirer side. And so we'll talk about that in different funding arrangements in a later slide. On the next slide, so the key taxing provision for employee equity plans is subdivision 83A, our employee share scheme rules. Again, some design objectives here. First of all, don't let the tax tail wag the dog. So make sure the plan meets all of your commercial and incentivization objectives first, and then we can overlay tax at the end of that. Things tend to fall over when we let tax drive the nature of the plan. Generally, employees are taxed and not the employer company. And it's critical when you're having an employee tax that you match the taxing point for the employee to a cash flow point, so that they're not left having to pay tax or even fund an exercise price at a point where they don't know how to get the cash to do that. And if we don't plan for that, that can derail the whole plan. For an employer perspective, usually it's the setup costs, but also understanding how the employee is going to be taxed so that there are no surprises down the track and everyone is aware of where everyone stands. And there are ATO reporting requirements as well. On the next slide, so when an employee is taxed, they're taxed on the discount provided to them. So the discount is basically the value of the equity at a particular point in time compared to the employee's purchase price for that equity. So if the equity value exceeds the purchase price, there's a discount provided to the employee, and that becomes ordinary taxable income to the employee. Now, you can decrease that discount component by the employee providing more funding. And if you fully fund, or an employee fully funds the acquisition of equity so that there's no discount, you actually pull yourself back out of the employee share scheme rules, and it can cause a number of other complicated tax issues down the track, particularly in relation to the loan arrangement itself, and if an employee leaves and you have to buy back that equity. On the next couple of slides, we talk about, well, when does the employee get taxed? So we plan for this upfront so that there's either an upfront taxing point or a deferred taxing point to meet the objectives of the scheme, and again, to make sure there's cash available from the employee in order to pay tax and exercise prices. So I'll let you guys read through the detail on these slides in more detail later on. So moving to common funding arrangements. So there's a couple of things that we see in practice as to how employees fund their participation. So two key ones, either employer provides a loan or we arrange a cashless exercise program. So some things to watch out for employer provided loans. FBT can arise if the interest rate on the loan is below the FBT rate. That is, unless the otherwise deductible rule can be applied by the employee, and then FBT kind of disappears, which is usually a good thing. But for non-dividend generating companies, FBT becomes an issue. For private companies with retained profits who make a loan, then we need to manage Division 7A. That's really critical. And so the loan may need to be set up with Division 7A loan terms, which are pretty restrictive. And then if we put a limited recourse arrangement in place, tax issues get pretty complex if the employee leaves, and we'll talk about that on the next slide. For a cashless exercise, basically what that means is the employee has an ability to sell shares in order to fund exercise prices and in order to pay tax. But this only really works with listed companies who have liquid shares, and it's easy for an employee to sell shares. It doesn't work well in the private space at all. So usually we'll see for employees that either they're not funding anything, or they'll fund a low amount for their plan, or we'll have some kind of loan arrangement in place. Okay, and then finally, what happens when an employee leaves? So key issues here, or the tax issues, revolve around whether or not the ESS tax rules apply or don't apply. So if the ESS rules do apply, then generally, in relation to the shares themselves, there are generally no other tax issues to worry about. But if it's a loan-funded plan, then we get into trouble, or we can get into trouble with FBT debt waivers, which we need to consider. You can have Division 7A deemed dividends arising, and also commercial debt forgiveness rules. These are all issues really for the employee, and we can generally get around the debt waiver issue. So the employee really needs to be aware that if they leave, then there are these potential tax bogeys that can hit them and need to be managed. If the ESS rules don't apply, then from the loan perspective, you've got the same issues as if ESS rules do apply. But you've also got an added issue that for the shares themselves. So it's all about understanding, well, how are those shares going to be bought back? So if there's a share buyback or a cancellation, then that can give rise to a deemed dividend and capital gains tax to the employee, and a loss of franking credits to the employer. So usually what we try to do is to, if we can, find an external buyer for the shares, as opposed to having the company buy back those shares. Sometimes it's not possible, but it's just something we try to put into place. Okay, that was pretty much it from me. Oh yeah, just a quick one. There are all sorts of complex corpse law issues that need to be managed as part of this. So as part of any share issue arrangement, please do seek good legal advice as well. Well, that's it from me and tax. I don't think we have any open questions.
Thanks, John. Thanks, Liz. I think that was a great session, everyone, and I hope you all got something out of it. If there are any final questions, please feel free to raise them in the box now. Alternatively, you can contact us directly. We'll look to do further sessions next year. So I hope you all have a wonderful Christmas and a happy New Year, and stay safe, everyone.